Good morning, class. Today we'll be going over depreciation. And depreciation is the expensing of a fixed asset, either be equipment or a building, over time, which adheres to the matching principle. We're going to match the expenses against the revenues in the period that those revenues were earned. So a fixed asset will last us several years or several accounting periods. So we're going to expense it off over time against the revenues for that particular year. So the information on the top is one of your Excel spreadsheet homework ones. And I'll tell you there may be some errors in the spreadsheet, which I leave in so you can correct. I believe one is here under useful life. When I clicked it in, it came up to date, so you had to change it over to number. So just know that you may have to make some adjustments in here. So I won't dispense with reading the whole thing. You can read the whole thing as you go when you're doing the program. But basically, here we purchased a used truck, and the cost is going to be whatever it takes to get it in operation, just like merchandise inventory. Whatever it costs to get it on the shelf, whatever it costs to get it in operation. Some of these things, like tires and things like that, would normally be expensed as an expense when they're done, but because this is a used vehicle and we're putting it on the books, we'll have to add all of the things in. So we purchased it for $90,000. The related costs were painting, tires, and engine overhaul. So that comes out to $9,000. So the total cost of the truck is $99,000. So cost minus its residual value equals its book value. Or depreciable cost, Depreciable cost equals cost minus its residual value. So $99,000 minus the $9,000. This is how much we can depreciate. The residual cost is your scrap value, or what will remain on the books after you depreciated things out. So here's a straight line depreciation schedule. The formula is the straight line method. Cost minus residual value, or depreciable cost, divided by its useful life, will be the depreciation expense for that year. Book value is cost minus its accumulated depreciation. So depreciable cost is $90,000 divided by 5 years, comes out to $18,000 fixed each year. So we'll write off $18,000 each year. It accumulates each year, so $18,000 plus $18,000 is $36,000. This is our accumulated depreciation, which would be added up into our T account here. And the difference is the book value. So we can see each year we're going to write off $18,000, our accumulated depreciation. So cost minus our total accumulated depreciation will leave us our residual value of $9,000. One extra thing I'll tell you in here is that the straight line method is the cost minus residual value equals depreciation of depreciable cost divided by useful life equals depreciation expense. But the straight line rate is 1 divided by the number of years. So 1 divided by 5 would be 20%. We could be multiplying the depreciable cost by 20%, and it'll give us the same amount. And we'll see that in the further ones. Next one is depreciation per unit. Cost minus residual value again equals useful life in units. So 99,000 minus the 9,000 divided by total miles, total useful miles, will give us the depreciation per unit. In this case, it's miles. So again, cost minus residual value divided by useful life in units. 99,000 minus the 9,000 divided by 100,000 miles, which is its total life, it figures. So the depreciation per unit is fixed. The schedule tells us the first 4 years we're going to depreciate it 22,500 miles each year, so 90 cents. times the 22,500 comes out to depreciation expense of 20,250. Okay, so here, once we've got the depreciation by units, we multiply it by the number of miles used per year, and this is the depreciation expense. So the depreciation expense for the first 4 years, since it's the same, is $20,500. So 20,250. 20,250 plus 20,250, our accumulated depreciation in the second year would be 40,500, and so on. So at the end, it said the last year, it would only be used 10,000 miles. So 90 cents per mile times 10,000 miles used comes out to 9,000 depreciation expense. We put it here. Our accumulated depreciation is fully depreciated at 90,000. Our book value, cost, 99,000 minus its accumulated depreciation, 90,000, comes out to the 9,000 book value, or the residual value. The last method is double declining balance, twice the straight line rate. Okay, we don't take out residual value from the beginning. We still keep it, 9,000. We still keep it, but we don't use it in the calculation. Okay, so the difference here is, remember in the first one, the first section, straight line method, I said the straight line rate was 1 divided by 5, which was 20%. Well, twice the straight line rate is 2 divided by number of years. So 2 divided by 5 comes out to 40%, or 0.40. So in that case, the rate is fixed. Okay, and the formula is book value times double declining balance rate. So the first year, the book value is 99,000 because we don't take out residual value. So 99,000 times 0.40. The first year, we're going to depreciate 39,600. That's going to be our depreciation expense for the year. Accumulated depreciation the first year is going to be 39,600. So 99,000, the book value, 99,000 cost minus its accumulated depreciation comes out to its book value, 59,400. So again, book value is what we use to multiply times these twice the straight line rate. So now it's 59,400 times 0.40. Depreciation expense is 23,760. Add that to the 39,600. Our accumulated depreciation is 63,360. Cost minus accumulated depreciation gives us the amount left we can depreciate, 35,640 book value. So in the third year, we come across 35,640 times the depreciation rate, twice the straight line rate, 0.40, comes down to 14,256. So we add that to our accumulated depreciation of 63,360. That gives us accumulated depreciation of 77,618. Book value, 21,384. So we take that book value times 40%, comes out to $8,554. And the accumulated depreciation, when we add that to the previous, comes out to our accumulated depreciation, 86,170. So book value at that point is 12,830. If we do it again in the fifth year, come up with 5,132, you notice the accumulated depreciation now is 91,302. We can't go below 90,000. Okay, that's the max we can go because we didn't take out the depreciable scrap value at the beginning in the formula. We got to make sure that we don't go above 90,000 of our accumulated depreciation. Okay, so the $12,830 minus our residual value, $9,000. In this last year, the most that we can depreciate is $3,830. So that's where we'll come into here. We'll put in that number, $3,830. And you'll notice the formula comes across. The accumulated depreciation is now $90,000, and it leaves us our book value of $9,000. So you want to make sure that in that last year with double declining balance, twice the straight line rate, that when it gets down to the later years, we can't go over our accumulated depreciation of $90,000, or as the residual value $9,000. So you have to make sure it's usually a plug-in figure that you're going to have to put in to make your accumulation equal out to $90,000. You'll notice that double declining balance, twice the straight line rate is an accelerated depreciation. We take more depreciation in the first year, then the second year goes down, then the third year, so it's a declining balance, okay? So our depreciation expense is declining over the 5 years. Units of production is the most accurate as far as units used. So we're multiplying, once we get the cost per unit, we're multiplying times the units used. In this case, they gave us, it came out to $90,000 because of the question. But you also have to look out on this one to make sure you don't go above the $90,000 accumulated depreciation. The book value has to be left at $9,000. And then the straight line, the most common used, is the same amount each year over the 5 years that it was used. So straight line method, same, it's the easiest one to do. Cost minus residual value equals depreciable cost divided by useful years. Gives you the depreciation expense. That's the easiest one to do. Units of production, miles is a unit of production. That's an easy one to do for vehicles. It could be hours or time for machines. Sometimes the number of hours a machine runs, they'll depreciate it over years. And then finally, double declining balance, if we want an accelerated depreciation, more depreciation the first year. It doesn't matter which methods we use. In the end, the most we can depreciate is the depreciable cost, which is $90,000. So it all comes out the same in the end, the same accumulated depreciation and book value. So I hope this tutorial helped you, and I wish you the best on this chapter. More to come. Thank you.